welcome to the channel JIV and CIV Made Simple. In this particular video, we are going to cover our CTP, that is Certified Treasury Management Examination, Certification Course Examination, Memory Based Question and Answer Session based on the examination which was held on 24th January. So a lot of aspirants were saying that almost 60% question were asked numerical. So what I have done, I have included some numerical question also so that you can check out how to go about attempting the numerical problem. So let's get started with our very first question that is on your screen. Hold pen paper calculator with you and try to solve the question on your own first and then see the explanation. This will help you master the concept. So the question is like this: in the context of CCIL role as the central counterparty, CCIL plays a very important role with reference to the central counterparty. Which of the following best describe the legal impact of novation? This is a very important word, and they ask this question: which impact the legal impact of novation during the clearing of the trade, right? Both in process and the legal terms. So the key word here is the novation, and the context is CCIL role as a central counterparty, or called CCP. So options they have given that CCIL act like an agent to facilitate the exchange of fund and securities between the buyer and the seller. B, original contract between the buyer and seller is rescinded and replaced by two new contract where CCIL become the buyer to every seller. Option C, CCIL provide a guarantee to the seller that the buyer will pay, but the legal contract remains strictly between the original bilateral counterparties. D, novation refers to the process where CCIL revalues the outstanding position at the current market price to calculate the daily margin requirement. So basically these are the four options that they have provided, and you have to choose the correct one. So just pause a little bit and think about it. Now let me explain. Let me explain using an example so that it becomes crystal clear what novation is all about. So assume that there are two banks, right? So this is the bank A and this is the bank B. They do a trade in the government security or forex. So what they do, they enter into a bilateral contract. Initially they enter into a bilateral contract, and this trade is then reported to the CCIL. Once CCIL accept the trade, suppose they accept the trade for clearing and settlement, something important happen, and that we call novation. Now listen carefully. The original contract between bank A and bank B is cancelled. So what happened, whatever was the contract between these two, it is now cancelled. Okay, so it is replaced by two new contract. It is cancelled and it is replaced by two new contract. Now you may ask me, sir, what are the two new contract? Yes, I will explain. So the contract number one, contract number one is for CCIL become the seller. CCIL become the seller to the bank A. So think about it. So this contract between A and B is cancelled. Now this CCIL, it act like a seller to the bank A, and bank A is the buyer, obviously, and CCIL become buyer. It become buyer for the bank B, who is the seller. Fine. So legally bank A no longer deals with bank B, rather, and bank B no longer deals with bank A. Both deal only with CCIL. So that means CCIL become buyer to every seller and seller to every buyer. See, this is the so much important concept that they ask this question every time. So CCIL become buyer to every seller and seller to every buyer. And if you understand it, you can easily answer this question. Now if you look at the option, let's check out the option. Option number A says that, let me highlight the key point. It says that right, CCIL act only like an agent. No, it's wrong. In novation, CCIL does not act like an agent, rather CCIL act like a principal party. Here the keyword is principal party, right? Principal party, not an agent. Option C, if you look at, they say CCIL only guarantee amount. It provide a guarantee. No. Guarantee is not novation. Guarantee and novation are separate thing, right? Here the original contract itself is replaced. So what is happening here? Contract is replaced. It's not a guarantee. Now if you look at the option D, they have provided, which says that novation means mark to market. Clearly they have mentioned that novation means mark to market. What do you think? Actually no, mark to market is a risk management process. If you look at the MTM, this is a kind of risk management process, but novation is a legal replacement of the contract. Okay, so what is the correct answer? B is the correct answer. This is the correct one. So remember, why novation is so much important. Let me tell you about this, why it is so much important. Because so a kind of risk is always there between when two parties are contracting, and that risk is called counterparty risk. I think you know about it, right? So suppose what happened, the bank B default tomorrow. Bank B failed to, fulfill their obligation. So that means defaulted. So bank A is still safe here. Why? Because it is a contract with CCIL. They have made the contract with CCIL, not with the bank B. Right. Second benefit of this novation is that, anonymity. Yes. Which means bank don't worry about who is on the other side of the trade. They trust the CCIL. The third thing is multilateral netting. Very important. This is another benefit. Please note it down. Super important. Multilateral netting. So you may ask me, sir, why are you explaining all these things? So sometimes it may happen that in the upcoming examination they ask you a question that what is the benefit of novation to the context of bank. So you must answer multilateral netting is one benefit. What is this multilateral netting? It means because CCIL is central to all trade. CCIL is central to all trade, right? That's why it can net multiple buy and sell position into one final obligation. So what is the correct answer? B is the correct answer. I hope it is crystal clear. So remember, novation means new contract, original contract is cancelled, vanishes, CCIL is the center, buyer to every seller, seller to every buyer. That's the point. Now let's look at question number 2. So question number 2 is on your screen and everything has been explained in detail in this particular PDF. You can check out. Now question number 2 is one numerical based question, calculation of modified duration. So friends, we are given a 5-year bond and some details like they have given. Let me highlight it. 5-year bond they have provided. Face value 1000 rupees. Coupon is annual coupon is 8%. YTM they have given 10%. Fine. So what they are asking you, and also they have given the Macaulay duration. Macaulay duration they have given 4.28 year. The question is not asking just to calculate the Macaulay duration. It is asking if Macaulay duration is 4.28 year, what is the modified duration? So our job is only conversion, not full bond calculation. Had it been the Macaulay duration, we have to do the full bond calculation, which will take a lot of time. But in the examination, they don't ask for that much lengthy answer. They just ask you to compute whether you know the formula or not. Let me explain. So let's first understand the idea first. So this Macaulay duration, it tells us on average after how many years we get back the bond cash flow. On average after how many years we get. Before continuing the discussion, let me introduce you to our CTP comprehensive course where you get entire everything content likewise as per the syllabus prescribed by IIBF, PDF, videos, mock tests at just one place. You can check out the content. You will get a separate folder for previous year question, capsule content which help you revise the entire content in a very short time. PDF section is there which consists of theory and MCQ. Unit wise, module wise, mock test quizzes is there, video section is there. In the video section I provide you explanation of each and every concept in a very lucid manner, and that too only 30 to 40 minutes per video, right? And the previous year question you get to see what kind of question have appeared in the recently held examination. As you can see, these are the PDF which you can download also. Everything is downloadable, completely downloadable. In the PDF section you get the module wise PDF, right? So you can check out every unit, and inside unit you will get theory PDF, MCQ PDF. You can download them also. And in the mock test and quizzes folder you get to attempt the quizzes based on the concept which we discussed in the video. So this is a fully fledged course. If you go through the entire content, it will hardly take 1 to 2 hours per day, and for 1 month if you go through it, it will surely help you. Many aspirants have cracked the examination using our content. You can also check out the link in the description section, or you can WhatsApp me on the number shown on the screen. Discussing that Macaulay duration tells you on average after how many years we get back the bond cash flow. But what this modified duration tells us, it tells us how sensitive the bond price is to the interest rate change, right? So modified duration is always derived from Macaulay duration. And what is the formula? How to compute modified duration from Macaulay duration? Let me tell you. So remember, this modified duration is equal to Macaulay duration divided by 1 plus YTM upon N. Now just apply the formula. In this case, Macaulay duration they have given. I request you to please pause the video, think about your own. So Macaulay duration they have given 4.28. This is the value. And YTM they have given 10%. Okay, and N is 1. N is 1. Why N is 1? Because the coupon is annual. It is annual coupon. That's why no compounding is there. So if you look at the denominator, we have 1 plus YTM upon N. So 1 plus 0.1 upon 1, which is 1.10. That is our denominator. And we have to divide the Macaulay duration by this 1.10. So remember, 4.28 divided by 1.10. that will give us 3.89 year approx. So the correct answer to this question is obviously 3.89 year. So just it was very easy question. Just you have to apply the formula and get the answer. So you can remember it like this: MOD is equal to MAC divided by 1 plus YTM upon N. Okay. So MAC under the pressure of YTM become modified. Just remember, MAC under the pressure of YTM become modified. Or simpler, modified duration is always smaller than macular duration. If the YTM increases, modified duration decreases, and if YTM are 0, right, both are equal. So what we have discussed, that macular duration is given first and then modified duration is derived from it. MAC divided by 1 plus YTM upon N is equal to modified duration. That's the formula that we need to keep in the mind. Now a very good question in the front of your screen, this is regarding the VIX. So friends, the question asks you that when Indian VIX increases, what usually happen to the market volume and what happened to the liquidity? So what is happening here, that Indian capital market increase in the India VIX, how it impact the market volume and the liquidity? That's the question. So we are not talking about the index level here, we are talking about the VIX, right? So option they have given, an increase in VIX usually lead to decrease in the trading volume. Option B, high India VIX level are generally associated with a surge in the Nifty option volume. Option C, they have given that Indian VIX and trading volume are inversely related. And option D, Indian VIX is a price based sentiment indicator and has no statistical correlation with the physical volume of the contract. Very good question. So we are not talking about the index level, we are talking about the VIX. What is the VIX? V for volatility. Volatility, which is the India VIX. Okay. Then we are talking about the trading volume. And the third thing, we are interested in the liquidity dynamic. So the keyword you must focus on, increase in the Indian VIX. So VIX has increased. So now what is Indian VIX? Indian VIX is called for the fear of the Indian stock market. What we call it, there is a term that we often call it. This is called the fear gauge, okay, of the Indian stock market. What happened, when this India VIX goes up, it shows trader expect big movement in Nifty. Trader expect big movement in what? Nifty, right? And either sharp up or sharp down. So big movement, whenever Indian VIX goes up, either they expect a sharp up or a sharp down. And uncertainty between the agency to trade. So in VIX goes up, so what happened, trader expect big movement, either the sharp increase or sharp movement can be on the other side, right? So it means more uncertainty. It means more urgency to trade. More urgency to trade. And when urgency is trading activity increases, so urgency increases, right? So what happened to the trading volume? So remember, trading volume also increases. That's the correlation, right? Okay. So now how the volume calculate? So Indian VIX calculating the Nifty price. Nothing like an institutional investor. Market uncertainty is very high. Market is very uncertain. What will happen? So fear of loss increases. Fear of loss increases. What institutions should do? They buy put option. What do they buy? The put option. Put option for hedging purpose. What put option is? Right. Option means buy. Put option means sell. Okay. So they buy. They buy this put option for protection. This causes massive demand for option. And since demand for option increases, right? So option demand increases. What happen? The premium of the option, the premium, it also increases. And what happen ultimately? That option trading volume increases. So what you observe, that high India VIX, higher option volume. Now that's from trading volume. You can see now option trading volume has already been increased. Now let's look at the liquidity angle. So here's a tricky but very important point, that during high VIX, market move fast. So VIX is high, market move fast, and volume is also high, but liquidity quality may reduce temporarily. Why liquidity quality may reduce temporarily? Because market movement, because market maker is higher risk. Market maker, they face high risk. They widen the bid ask spread. So whatever spread is between the bid and ask, that get wide, and then they demand higher premium to trade. They demand higher premium to trade. So remember, whenever I say this high VIX, it means high volume but stressed liquidity. If you look at the option, now option number A says high volatility scare away institutional investor. It says that now high volatility scare up institutional investor. This is wrong. Institution actually trade more during volatile period, right? For hedging, rebalancing, and arbitrage. What about option C? Option says that volume peak only during low period. You can see. So actually this is wrong because low VIX represent complacency. Volume often dry up in very low VIX period. Option D says that Indian VIX has no correlation with the volume. Indian VIX has no correlation with the volume. So actually, this is completely wrong. Indian VIX is built from the active coupon order, right? So remember, the correct answer to this question is none but option number B. That high India VIX are generally associated with a surge in the Nifty option volume. Okay, so B is the correct one. So you can remember it like this. Let me give you a memory trick to remember. Just remember it. That suppose you have a high VIX. It means high VIX, high fix, right? So you should fix your risk. You should fix your risk. So what happens, whenever fear rises? See this logic. VIX increases, fear rises, right? Hedging increases, and option volume increases, right? So Indian VIX is a fear gauge. Rising PIS signal expected large market move. High VIX lead to heavy option hedging. I hope the concept is crystal clear. These kinds of. Now let's look at the third question of today's session. So I think this is the fourth one, and this is a numerical based question. Very good question. So friends, let's understand what the question is asking. We are being given the market price of government security. How much is the market price? 105.50 per 100 rupees face value. Okay. And then modification also they are provided 7.20. And the question is, what is PV01? That is the price value of a base point of the bond. Yeah, remember, this is not a duration question. It is a price sensitivity question, right? So options are given, these are the options. Now you may ask me, sir, what is the meaning of this PV0? Okay, let me explain. See, this is not just a question answer session. This is the concept building session also. I explain everything from the scratch, right? And then I explain each and every option, why one option is correct, why one option is wrong, so that you could have a complete understanding of the entire concept. See, PV01 means how much the bond price will change. How much the bond price will change if yield increases by 1 basis point. Okay. So now very important point I am telling you, that 1 basis point, that is equal to 0.01%. That is equal to 0.0001. Right. This is what 1 basis point is. 0.01%. So yield increasing by 1 basis point. How the bond price will? I know this equation very well. I think you are familiar with this equation. That when yield increases, price decreases, and when yield decreases, price increases. So PV01 is the risk in rupee or price, not percentage. Please remember, PV01 it tells us the risk in terms of rupee. What is the formula to use? Yes, you just have to command over the formula. PV01 is equal to modified duration multiplied by bond price multiplied by 0.00001. Now let's apply the concept. What's the modified duration they have given? 7.20, right? And then price they have given, I think, how much is the price? You can see 105.50. Okay, and 1 basis point, 1 basis point, let me write down. 1 basis point is 0.0001. Okay, so now just apply the formula. So you can write it like this: PV01 is equal to 7.20 multiplied by 105.5 multiplied by 0.0001. So that gives us how much? After computation, you will get 0.07596. Yes, yes. Option number B is the right one. So it means that for every 1 basis point increase in the yield, what it clearly means that suppose your yield increase by 1 basis point. So what is happening to the bond price? It will fall approximately 0.07596. That is what I mean to say. So what is the PV01? PV01 simply means that it means what, it's a price sensitivity. How much the bond price will change if the yield change by 1 basis point. So when we get this value, what I mean to say that if the yield increases by 1 basis point, bond price will decrease by 0.07596. And how do we compute it? Write the modifier, we multiply by the 1 basis point, and we further multiply it by the bond price. Right? That is how we do. You can remember it like using a trick. I always use a trick to remember it. How you can remember it? PV01 is equal to D into P into what? Is equal to D into P into PV. BP, sorry. BP to be more precise. D into P into BP. Fine. So BP means what? 0.0001. So the modified duration is given. Okay, multiplied by price and then knock off the 4 decimal. Just have to modified duration multiplied by price, right? And then knock off by 4 decimal. So what we discussed, PV01 measures the price change for 1 basis point yield movement. Always use modified duration, not Macaulay duration. And 1 basis point is equal to this 0.0001. Higher duration, higher interest rate risk. Now the second part of the question, same question, second part. Now let's break down the question. So treasury desk is there. They hold total face value is 10 crore. This is written in numeric term also. BPV they have given 0.05 per 100 rupees value. Market yield has risen by 5 basis points. So the question is, what is the estimated impact on the portfolio value? So what will be the impact on the portfolio value? So you can put loss of this much, gain of this, loss of this much. This is like this option. Basically, here we must be clear about this BPV. What is the BPV? That is the single point. So basis point value, you must understand it clearly. What the meaning of the 1 basis point? See, when I say this BPV, it tells us how much the bond price will change for a basis point, that is 0.01% change in the yield. Right? That is what BPV is all about. So how much the bond price will fluctuate for 1 basis point change in the yield. In TV01 also I told you how much the bond price will change, the yield change by just 1 basis point. Okay. Similar concept is there, BPV, basis point value. Okay. So that means how much the bond price change for 1 basis point change in the yield. And you know the relation very well, that yield increases, then bond price decreases, and yield decreases, then bond price increases. So because yield are rising, so in this case what is happening, in this case yield are rising, because clearly they have mentioned here that yield are rising, yield have risen by how much? 5 basis point. Because yield are rising, what will be the impact? Bond price portfolio will face a loss. So what we need to do, we need to convert this total face value into per 100 unit. Okay, how do we go to do what? Because BPV is given per 100 face value, so we first calculate how many 100 units are there in the total face value, that is 10 crore divided by 100. So we write face value per 100 unit. We want to make this unit same. Okay, that is how much? I think it was 10 crore, right? 10 crore divided by 100, that will be 10 lakh units. Okay, now the first step is to compute the FB per 100 unit. Now calculate the total BPV of the portfolio, total basis point value of the portfolio. How to go about doing it? So they have clearly mentioned that per 100 rupees face value, the BPV is 0.045, right? And total face value is how much? This much. This is just 10 lakh. Just multiplied both of them. So 1 000 multiplied by 0.045. That will give us 45,000 rupees. That is the total BP. Total BPV. Total BPV is 45,000. Now you apply the, how much is the actual change here? Actual change is 5 basis point. Okay. So that BPV is 45,000. It means, bond price change by this amount for 1 basis point change in the yield. So this is amount for 1 basis point change in the yield, but actually yield change by 5 basis point. So how much will be the price change? Just multiply it by 5. So price change will be how much? 45,000 multiplied by 5. That will give you 2,25,000. Okay, so wait, look carefully. Actually, this is wrong. I think this is not 45,000, 4,500. So 1 0 will reduce. 2,25,000. Sorry, 22,500. The correct answer is 22,500. Yes, the correct answer is option number A. Right. Correct answer is option number A. And obviously there will be loss because yield. So yield rose. Now you may think about the direction. So yield increases. So bond price fall, and the bond price falls. So this is a loss because the investor want bond price to increase. So this is a loss for them. Okay. I hope it is crystal clear. Now so remember, just you can remember this formula like this: BPV multiplied by BPS is equal to price impact. Okay, BPV basis point value, and we have multiplied by the BPS change, basis point change. How much the basis point has changed? 5 basis point in this particular case. That will give you the price impact. And one more thing, yield up, price down. More basis point multiplied by BPV. Now the third question of the same, given 850 and the market value is 10,20,000. The question is the modified duration of this position. So remember, DV01 is already calculated. We only need to reverse the formula to find the modified duration. What is this DV01? Let me explain. See, when I say this DV01, it means how the value of the bond will change if the yield change by 1 basis point. Right. So DV01 means value of bond, how it will be changed? If the yield change by how much? 1 basis point, or we can call it 0.01%. So dv01 we can call it price sensitivity. We can call it price sensitivity, and this is always measured in the currency term. See, in this case what is happening, that we are talking about the value of the bond will change, dv01. Okay, in the previous case we talked about the price of the bond, and yield change by 1 basis point. So it is price sensitivity measured in currency term. And what modified duration tells us? Modified duration tells us percentage price change for 1% change in the yield. So modified duration always tells us the percentage price change. Please understand, percentage price change. Okay, so it tells us that see, price will change by this much percentage for 1% change in yield. So both are directly connected by a formula. And what is the linkage of the formula? Let me write it down. So you can write it like this: dv01 is equal to modified duration multiplied by the market value multiplied by the 0.001. That's it. Okay, now you can rearrange the formula. You can rearrange it like this: md is equal to dv01 upon market value multiplied by 0.001. Okay, now just put the value. So dv01 is 850, and market value, how much they have given? Market value is I think 10,20,000, right? It is 10,20,000 multiplied by 0.001. This gives us how much? So if you look at the denominator, that is 102. So that gives us 8.33 as the modified duration. So if you look at the option, what are the options they have provided? Yes, 8.33 is the correct answer. That's the correct. So remember, dv01 is equal to duration multiplied by value multiplied by bp, and bp is always how much? 0.0001. okay, so if dv01 is given, divide by market value and knock off the 4 decimal. So it measures rupee or price change for 1 bp. Okay, that's the point. Now let's look at the next question. So we have computed the dv01 also, and in the previous case we have computed the pv01 also. Now one question may arise in your mind: sir, what is the difference between dv01 and pv01? Okay, so in that case I told you this is not a duration. PV duration means how the bond price will change if the yield change by just 1 basis point. That is what PV duration is all about. PV01 is all about. Okay, and in that case what formula we use? Same formula: modified duration multiplied by bond price multiplied by basis point. But in this case we are not using the bond price, we are using the market value. That's the difference. Okay, so here the point is market value, dollar value of basis point. So here we are using the market value, there we were using the bond price. That was with respect to the bond price. Okay, that's the difference. Formula is equally simple, similar, no difference in the formula. Now the next question we have is regarding the IBPC. Very good question. That's called Interbank Participation Certificate. So what it is all about, that in the context of IBPC, which of the following statement correctly describe the regulatory framework regarding the risk sharing and asset classification? So option they have given: IBPC is who without risk sharing can have a tenure exceeding 180 days to help the bank meet long-term liquidity requirement. Then in an IBPC with risk sharing, the participating or buying bank must treat the amount as a loan in advance. For option C, for IBPC issued with risk sharing, the health code of the underlying crop loan or SME loan remain the responsibility of the issuing bank. And option D, IBPC can be issued to non-banking financial company and mutual fund to broaden the secondary market for variety sectors. These are 4 options that you have to select the correct one, correctly describe. So see, before getting into detail of this question, let me first explain what this IBPC is all about. So remember, IBPC are the instrument through which one bank sell participation in its loan portfolio. Right, let me write it down. IBPC are the instrument through which, this is the one bank number 1, they sell participation in the loan portfolio, and this is the bank number 2. What they do? They buy participation. So this is buyer and this is the seller. Okay, mainly it is used for priority sector lending management. Okay, and it also used for liquidity and risk distribution. between the banks. So that's the point. So what we have discussed so far, that IBPC are instrument through which one bank is selling participation, other bank is buying participation. Mainly it is used for priority sector lending and liquidity and risk distribution between the bank. And IBPC are only issued between bank. Please remember, this is the bank 1, this is the bank 2. Okay. Priority sector lending management is the main objective. Now there are two kind of IBPC. One is called with risk sharing. One is called, with risk sharing. So what is the meaning of it with risk sharing? That means buyer, that is the participant bank, they share the credit risk. So in the case of risk sharing, the buyer share the credit risk. And suppose the loan become NPA, the loss is shared proportionally. Okay. So when with a buyer, the bank, share the credit risk, and loan become NPA, loss is shared proportionally. And usually this with risk sharing is used for PSL, and tenor is usually 90 to 180 days. That is with risk sharing. Now the second kind of IBPC is without risk sharing, which means what, that buyer never take any kind of credit risk. Buyer does not take a credit risk, means no risk of default. So risk remain with whom? Risk remain with the issuing bank, whoever has issued this certificate. Okay. And it acts like a short-term interbank borrowing, less than 90 days. Now, asset classification. This is the most tested concept. Very, very important thing. Let me explain. So regarding the concept regarding the asset classification, that even when IBPC is issued, issuing bank remain the loan manager. Okay. So what they do? They monitor, they recover, and they do the asset classification. So participant bank only share the risk but does not classify the asset independently. If you look at the option that they have provided, option number A says that IBPC issued without risk sharing can exceed 180 days. This is wrong, because without risk sharing is always less than 90 days. Maximum tenure is 90 days only. Option number B says that is 3 months. B says that participant treated like a loan. So asset classification, just now I told you that even when issuing bank remain the loan manager, monitoring, recovery, asset classification done by the issuing bank, right? Participant bank only share the risk but does not classify the asset properly. So if you look at the option B, what it is taking, it is telling that participating bank, they treat the amount as a loan. Issuer remove asset from the balance sheet. No, that's wrong. Issuing bank never loses management responsibility. Management responsibility always lie with the issuing bank, right? And asset cannot be fully de-recognized. What about option C? For an IBPC with risk sharing, the health code of underlying crop or SME loan remain the responsibility of the issuing bank. Yes, correct. C is the perfectly correct. And option D says that IBPC can be issued to NBFC and mutual fund. It is completely wrong. I think we have already discussed that IBPC is a kind of instrument which are interbank only, right? It can never be issued to NBFC or any kind of mutual fund, right? So what we learned from this discussion is that there is a very important learning. Let me write down, right? We got to learn that you cannot, risk can be shared, right? Risk can be shared, right? But responsibility cannot be shared. Very important line. Responsibility cannot be shared. You can share the risk, but you cannot share the responsibility. Or remember that IBPC with the risk sharing, loss is shared, classification is never shared. So responsibility means what? Responsibility means classification. You never share the classification, you share the risk, and that too with a risk. So what we have discussed regarding IBPC, let me just summarize the point. So they are bank to bank instrument. Two types I told you, without risk and with risk. So in the case of with risk, what happened? The credit risk is shared. So risk is sharing happen, and asset classification remain with the issuing bank. Issuing bank asset classification. I hope this is crystal clear. Now, very good question. Last question of today's discussion. We have many much question available that will be available in our paid course. If you want to get answer to all this question, you can join our paid course, and surely many aspirants have cracked the paper. You can also crack in the very first attempt. Let's look at the question. In the context of the Government of India debt instrument, which of the following statement correctly distinguish the CMB from a treasury bill? Cash management bill and treasury bill difference they are asking. So option number A, The T-bill are issued to fund the long-term fiscal deficit. CMBs are issued strictly to manage temporary mismatch. Option B, TMB have a fixed standard tenor, while CMB are non-standard and are typically issued for tenor less than 91 days. Option C, CMB are issued eligible for a statutory liquidity ratio, while T-bill are considered part of the STM portfolio. Option number D, T-bill are issued at a discount to face value, while CMB are interest-bearing instrument. Very good question. So first of all, this question is focus area are tenor, purpose, and issuance pattern. So both T-bill and CMB, who issue them? Either you call it T-bill or you call it CMB. Both are issued by the government of India. Both are short-term borrowing instrument. Both are zero coupon security. No interest. Zero coupon means you will not get any interest, and they are issued at a discount and redeemed at the par. But why do we have two similar instruments? Yes, you look at these are much similarity, but why do we have different instruments? See, because their tenor and predictability differ. See, in the case of T-bill, what happened? It is very much predictable. This is very much predictable. They are issued in a fixed tenor, like 91 days, 182 days, and 364 days. And auction calendar is announced. Their auction calendar, they are announced in advance. And this is the regular part of the government borrowing program. But if you look at the CMB, this was started way back in the year 2010 and issued only when required. When required, they are issued. Okay, there is no any time schedule for CMB. And tenor is flexible. And tenor is always less than 91 days. They are used to match the temporary cash flow mismatch. Okay, so they are used to match the temporary cash flow mismatch. So it is a kind of short-term liquidity tool. So if you look at the option, A says that treasury bill are used to fund the fiscal deficit. No. Both of them are short-term instrument, not long-term deficit tool. C says that only CMB are eligible for SLR. No, that's wrong. Both are eligible for SLR. Both are SLR eligible. D says that CMB are interest-bearing instrument. No. Nothing give you interest. Actually, both are discounting instrument, zero coupon instrument. Zero coupon means they don't provide you any coupon. Okay. So remember, there's a trick you can use to remember it like this. You can think of T-bill like a 3 tenor. 3 tenor, isn't it? 91, 182, and 364. And CMB, you can call it, cash mismatch bill. This is my definition. Cash mismatch bill. Right? So issue only when cash gap suddenly appear. So that is all we need to learn from this particular chapter. We have some more questions that will be available in our paid course. For more detail, you can WhatsApp me on this particular number. I hope everything is crystal clear. If you want me to bring the part 2 lecture, just write part 2 in the comment section. Please